Hi, I'm Todd Rosenbluth, Head of Research at Vetify. I'm excited to be joined by Graham Day of Innovator ETFs, and we're here to talk about the BALT ETF. Graham, thanks for joining me.
Todd, it's great to see you again.
Well, my pleasure. So, we're in unusual times. We're in bearish times for the equity markets. We've seen much more volatility in the overall marketplace. How can defined outcome ETFs help advisors in this environment?
Well, Todd, I think we have an environment where not only equities being in a bear market, but you really have bonds doing things that most investors have not seen really in their lifetimes. Bonds are going down with equities. Because of that, advisors are looking for ways to add more levels of certainty to their portfolios, to be able to communicate to clients, here's what you can expect to receive. And that really has not been available in the ETF wrapper until the defined outcome ETFs came out just over around 4 years ago. And what these ETFs allow advisors to communicate to clients is a known level of upside potential to the equity markets, but more importantly, known levels of built-in buffers against downside loss. I think with equities and bonds falling together, being able to know that I have a built-in buffer of, say, 15% against market losses over the next year is extremely valuable, as risk management has been a key focus of advisors here in 2022.
Well, you mentioned not only the equity markets, but fixed income with rising interest rates, falling bond prices, inflation on the mind. Can defined outcome ETFs serve a purpose for the defensive side of a portfolio that fixed income might normally have handled?
Absolutely, Todd. In fact, that is one of the ways that we're seeing advisors adopt these ETFs. What we're finding is that with interest rates rising, bonds falling, most advisors are underweight bonds. They don't see a path forward for the next few years. The Fed has just started to hike rates. The outlook for bonds is not appealing for the next few years, but they still need to add or have defensive attributes to that side of the portfolio. And so the thought of being underweight bonds and just investing unhedged in equities is equally unappealing. Equities are falling, recession risks are rising, and so the buffer ETFs have been a great way for advisors to maintain those defensive characteristics by utilizing the buffer ETFs. And buffer ETFs are really, in a sense, a hybrid between equities and bonds. You get the upside participation of equities to a cap, but then you also have the known levels of built-in downside buffers. And that, again, that risk management that I have a buffer of, say, 15% is very appealing because bonds are unable or have not delivered that same type of protection for a portfolio that advisors have been accustomed to for really the last 30 years.
So you talked about the acceptance. Let's just expand that a little bit. We're seeing advisors have more access to these defined outcome ETFs, in particular the ones from Innovator. Are you seeing traction improve?
Absolutely. And I think it's helpful to take a step back that defined outcome ETFs, what we've done is to take payoffs that were previously only available in structured notes, indexed annuities, and make them available to advisors in the ETF wrapper. It solved a lot of problems. It got rid of commissions. It got rid of opaque fees. It added liquidity and transparency, tax efficiency. It got rid of credit risk. And so because of that, many advisors are now able to utilize these payoffs through the Innovator ETFs in ways that they really never had available to them in the past. And these ETFs we've had, like I said, for almost 4 years now. And all these ETFs have done exactly what they said they were going to do. We've had over 150 of our defined outcome ETFs complete their outcome periods and do, like I said, exactly what they were expected to do, whether it was in an up market, a flat market, a down market. These were tested in COVID. They did exactly what they were supposed to do. And I think that type of certainty when it comes to risk management, especially today, is extremely valuable for advisors and their clients.
Well, you have a broad suite of products, but we're going to focus on just one of them. The ticker is BALT, B-A-L-T. Let's talk about that, the attributes of this ETF.
BALT is an ETF that we are really excited about because what this ETF does is it provides upside exposure to the U.S. equity market up to a cap, but it has a downside buffer built in of 20% every single quarter. And so, really, the ticker BALT was we decided upon that because we were looking to solve a problem advisors were having: is how do I stay very defensive? How do I get bond-like volatility, but without interest rate risk, without credit risk? That is why we built BALT, because when you look at the performance of something like BALT, it gives you some upside potential to the markets, but it eliminates the risks that many advisors don't want to take on with the bond market today. And since its inception, this ETF has actually delivered positive returns. So over the last year, it's delivered positive returns despite equities over that same time frame dropping around 9 or 10%. And that's because of the quarterly outcome periods. If the market rises, this ETF will capture a portion of that upside. But that 20% buffer comes into play on a quarterly basis, as we've seen here in 2022. The first two quarters, both negative. BALT buffered investors against those losses, both in Q1 and Q2, which has allowed it to deliver that positive return since inception. And when you compare that to the performance of bonds, short-term bonds, core bonds, long-term bonds, BALT has delivered great returns, but also that bond-like volatility that many advisors are looking for. And so we're seeing a lot of traction in BALT today.
Well, that's great, Graham, and it's exciting for the audience to learn more about this new innovative ETF from Innovator ETF. So thanks a lot. Thank you, everybody, for tuning in. Till next time, have a great day.